Hi, and welcome to Strategy 5. In this lesson, we will explore the market structure strategy, a powerful approach to identifying and trading within the prevailing market trend. This strategy is designed to help you make informed trading decisions based on market structure. Before we begin, I want to start off with a trade disclaimer. Everything I teach is not considered as financial advice. It is for educational purposes only. Take a moment to review. Alright, so the market structure strategy revolves around understanding the dynamics of a market trend and using it to your advantage. So here's how it works. Identifying the trend. The first step is to identify the trend. The market is in an uptrend when price is making higher highs and higher lows, and in a downtrend when price is making lower lows and lower highs. So here we have higher high, higher low, a higher high. We are in a clear uptrend, and here we have a downtrend because we are making lower lows, lower highs, lower lows, lower highs. And once you have identified the trend, mark the significant swing highs and swing lows that occur as part of that trend. These points serve as reference levels. So you want to mark the swing low and swing high of the given trend. And trading in the direction of the trend. When the price makes a higher high in an uptrend or a lower low in a downtrend, it indicates potential for continuation of the trend. To capitalize on this, you can look for opportunities to enter trades in the direction of the trend on pullbacks. These pullbacks provide advantageous entry points. So in an uptrend, we want to get in the pullbacks, so in the retracements. Long entry on the pullbacks, target the high, or stay in until you see sign of weakness, for example, market structure break. And here you can see a downtrend. We want to get in on the retracements. So let's say if you were to get in here, you will target the low. Let's say this was a downtrend. We have a lower low, lower high. Let's say it was in a lower time frame. We want to get in on the retracement and target the low, or we can stay in until we see a market structure break. For example, we make lower highs, lower lows, lower highs, lower lows, and the market structure will change if we were to break the previous high. So that will be an indication of sign of weakness, and we want to get out of the trade. Selecting entry technique. For your entry points, you have several options, such as using the Fibonacci ladder, identifying order blocks, exponential moving averages, or relying on other forms of confluence based on your trading strategy and analysis. So here, the reason to get in a trade was the market structure. So as you can see, we have a high, a low, a higher high, a higher low, and a higher high. So we are in a clear uptrend, and we want to get in on the pullback. So for your entry point, you can use, as we can see in this example, we use the Fibonacci ladder tool that we discussed in the previous strategy. We pulled from the low to the high, and we get our entry levels, and we want to get in on the retracement, and we place our stop loss below the previous low and target the high, or we can trade based on the Fibonacci ladder tool. Another way to get in is with the exponential moving averages. First, we identify the trend. As you can see here, we have a high, low, higher high, and a higher low. So now we are in a clear uptrend, and we want to get in on the pullbacks. So here we use the 55 EMA and the 100 EMA. So as you can see, the retracements, how they are respected on the 55 EMA and the 100 EMA in this example on the euro against the dollar. And let's say we got in here, we want to target the high or stay in until we see sign of weakness, which you can see here we have a higher low, a higher high, and then price breaks the previous low. So now we have a change in market structure. So that's an indication of a possible reversal. And setting a stop loss. Risk management is essential in the market structure strategy to protect your capital. Set your stop loss just above the previous high in a short trade or below the previous low in a long trade. This stop loss placement is based on market structure. So again, in this example, we identify the trend, which we have here a high, low, higher high, a higher low, which now we are in a clear uptrend, and we want to get in on the retracements. For that, we use the 55 EMA. When price reaches the 55 EMA, we get in. Let's say we got in here. We want to place our stop loss below the previous low, which is here. And we target the high, or we stay in until we see sign of weakness. Let's say we were to get in here. We will stay in until we see this higher low break. And Fibonacci ladder in confluence with market structure. This example is using the Fibonacci ladder in confluence with the market structure. We can see 3 levels of confluence in this example: the 55 EMA, the Fibonacci ladder, and market structure. So as you can see here, we can use multiple levels of confluence. The first one is the market structure. We are in an uptrend, so that's our first level of confluence. Then we add the 55 EMA, and then we add the Fibonacci ladder to where we want to get in on the retracement. And you can see we have 3 levels: market structure, 55 EMA, and the Fibonacci ladder. And we can get in this retracement. And we place our stop loss below the previous low. And that's the market structure strategy, which is a dynamic and adaptable approach to trading. It allows you to align your trades with the prevailing market trend, increasing the likelihood of success. And keep in mind that trading, even with a solid strategy, carries risks, and it is essential to practice proper risk management and understand that you will lose a lot of trades before you can be a good trader. Having time in the charts always beats trying to time the charts. So that's it for the market structure strategy, and I will see you on the next one.